Among others, there'll be HCL Tech, which will come out with Q4 numbers. Deal ramp-up may support growth, actually. Darshita here to tell us exactly what the street is expecting. Darshita.
Let's look at HCL Tech Q4 FY26, which may look soft on the surface, but here are the few important nuances that the investors should not miss. To start off with, the revenue in the dollar terms is expected to see a decline of about 3% sequentially. Now, this is largely due to the seasonal weakness in the product business. However, in the rupee terms, the growth is expected to remain stable, coming in at around rupees 34,000 crores, indicating underlying resilience. On the margin side, EBIT is expected to come in the band of around 17.5 to 17.7%, which is approximately 90 basis points down sequentially. Now, this is mainly because of the wage hikes and the restructuring cost. But encouragingly, on the profitability side, PAT is expected to see a growth of about 14% QOQ, supported by the rupee depreciation. For this quarter, the street is already factoring a slight dip, with the constant currency to see a decline of about 1.7% sequentially, largely due to the seasonal drag in the product segment. Moving to the deal momentum, the outlook remains encouraging, with the TCV expected to come in at around $2.5 billion, which supports the medium-term visibility. Finally, looking at the guidance and the key expectations, the street is expecting the revenue growth to come in at around 3 to 5% for FY27, and the margins to move slightly to the aspirational band of about 17.5 to 18.5%. To sum this up, Q4 may appear subdued, but the real focus will be on the management commentary, AI-led growth, and the margin trajectory. And that's where the street and the markets are focusing on.
Okay, thank you so much for